The Rebel Capitalist Show.
Now let's dive into the 60-40 discussion. I was just talking with a guy that runs quite a bit of money. I'm in St. Bart's right now. We were at dinner, and he was talking about someone that works for Dalio, I think, came out and was talking about how, ironically, the 60-40 portfolio is dead, because I think that was kind of their claim to fame. And so I know you talked about this, or you've talked about this in several of your recent interviews. So can you discuss the problems with that, especially in regards to bonds, the 10-year, and if by chance the 10-year were to go negative?
So in really simple terms, it's important to understand the components of a portfolio. So when we say 60-40, what we're saying is bonds and equities, right? Or equities and bonds, typically 60% equities, 40% bonds. Bridgewater's claim to developing what's called risk parity is actually to increase the bond portion of that portfolio, because the real value to bonds in a 60-40 portfolio has been the low volatility to the bond instrument, right? So if you think about a portfolio that is 60% equities, and average volatility in equities is around 60% or 16%, I'm sorry.
Okay.
And 40% in bonds, and the average volatility in bonds is around 1.5%, right? If you figure out what proportion of the volatility of that portfolio is tied to equities, it's just off the charts, right? It's basically 100% equity portfolio. Mm-hmm. The bonds are a ballast in that portfolio, effectively providing you with a little bit of income associated with it, and effectively low variability that allows you to add to the equities at times that they've fallen in price and become relatively attractive, right? The innovation of Bridgewater was to say, look, you should actually increase the proportion that you own in bonds so that they represent a similar proportion of the total volatility. So instead of 60-40 portfolios, they would typically be running 60-40 portfolios, right? A levered portfolio, right? The problem with the fact that the income on bonds has fallen so low has two impacts to it. One is there's no more income associated with that. So effectively, you're just sitting with a cash portfolio for all intents and purposes. But also, because the interest rates have fallen so low, the volatility of those bond prices has increased, right? So their ability to go up and down a lot. And so it represents a larger and larger fraction. The last thing that has been important about that bond portfolio, and this has been a long-winded way to get to the question that you were asking me, is because the central banks, because the Federal Reserve has reacted to risk-off events where equity markets have fallen by lowering interest rates. That's been their response function. When they do that, when you lower interest rates, what you're actually doing is driving the price of bonds higher.
Right.
Right. And so what that has meant is that the correlation between bond returns and equity returns has been negative, which is fantastic from a hedging perspective. But you also have been getting positive returns from bonds. Mm-hmm. Right. So the problem is, if the returns on those bonds, the coupons or the yield to maturity goes negative, then while you have a hedging instrument, it no longer offers you a positive return. Mm-hmm. And that's the same thing as just owning a put on the S&P. And the efficacy of that put is increasingly uncertain as you approach that zero lower bound and the potential for interest rates to go negative. So it means that there's less hedges available to people. And if there are less hedges available and those hedges cost more money, then you need to reduce your risk allocations, right? And so this is the point that I make in the end game.
Is that
your portfolio becomes more volatile and lower risk, and so and lower return. I'm sorry. So more volatile, higher risk, lower return. In that scenario, you have to reduce your allocations. You have to reduce the size of that portfolio. That Bridgewater 60-40 portfolio, right, where it's 3 times levered, needs to be reduced back to a 60-40 portfolio, and the implications of that are that you have to reduce the demand for financial assets in total. Right, that's the concern that I have if we push those interest rates negative, that effectively, while we think what we're doing, what the Fed thinks it's doing by lowering interest rates is stimulating the economy and consumption, ironically, what they actually have done is stimulate demand for financial assets. And if that comes to an end, then you have a significant problem in the markets.
Right. So I'm thinking this through here. If rates go negative and that forces selling, wouldn't that increase the rates and get to some sort of equilibrium, or am I not seeing it right?
Well, what you would see is you would see a selling of the negative policy rates, right? So you would see a steepening of the yield curve. You could potentially, depending on how committed the central bank indicated it was, you could potentially see actually longer dated bonds sell off on that event, right? And so that would be potentially quite bad for investor portfolios that are levered to those bond exposures.
Right.
And I think that's ultimately what people are talking about when they say this trade is largely over, right? The 40-year bond bull market that began in 1981, it's hard to see that it has much longer to go.
Okay.